Good morning, everyone. I'm talking about one of the topic in international trade, balance of payment. Balance of payment is a systematic record of all economic transactions of an economy with the rest of the world. And balance of payment has its own significance in its monetary policy, fiscal policy, and in all economic policies of an economy. And it also show about the economic development of an economy. Talking about balance of payment, it is a systematic record of visibles and invisibles as well. There are two important concepts in balance of payment. When we talk about that, we have BOP and BOT, balance of payment and balance of trade. Balance of payment includes both visibles and invisibles, and balance of trade is only about visibles. Talking about the distinction between BOP and BOT, BOP is a broader term because it taking into account of visibles, invisibles, and capital transfers, but balance of trade takes account only the visibles of an economy. Hence, it is considered to be narrow one. And balance of payment includes all transactions, including, as I said, visible, invisibles, and capital, but balance of trade include only about the visible item. And BOP is equal to, and the two components of balance of payment when we talk about its current account and capital account, and BOT is only about the net earning. That's basically export minus net payment for import. And few important factors which is affecting balance of payment as a whole are conditions of foreign lenders, economic policy of the government, and all factors of balance of payment, balance of trade as well. But talking about balance of trade, the few factors which affect the balance of trade are cost of production, availability of raw materials, rate of exchange, price of manufactured food at the domestic economy. Talking about the significance or importance of balance of payment, as I told, or as the definition itself states, that it's a record of all the economic transactions which create the demand and the supply for the currency of an economy. And it will even enable the organization to judge or to have an understanding about the economic and financial status of an economy in the short term. That is one financial year. Balance of payment also confirm the country's international trade and exchange rate of the currency, that is domestic currency, and this will also serve the base for various monetary and the fiscal policies as well. And what are the general rules of balance of payment accounting? And the very general rule which is followed in balance of payment accounting are: if a transaction earns foreign currency for a nation, it is a credit and it is recorded as a plus item. If the transaction involves spending of a foreign currency, it is a debit, it is recorded as a negative item. The various components, for example, current account, capital account, reserve account, and errors and omissions. Talking about the current account is a statement of actual receipts and payments in a short period, which includes all the exports and imports of an economy, both visible and invisible good. And this can be either surplus or deficit as well. The current account includes the export and import of services, interest, profit, dividends, unilateral payment and receipts from or to abroad. Balance of payment on current account refers to the inclusion of three balances such as merchandise balance, service balance, and unilateral balance. These are the three important balances which appears in current account. Trade balance is basically the merchandise exports, merchandise import, that export and import of both the goods and services. Income balances are the net investment income, that is net income receipts from the assets, and net international compensation to employees, that's basically net compensation of employees. And the next one is net unilateral transfer, that basically the transfer payment, the gifts from foreign country minus gifts to the foreign country. Then talking about the capital account is inclusive of all the capital transactions of an economy. capital account records all the international transactions that involve a resident of the country concerned changing either his assets or his liabilities to the resident of other country. Transactions in the capital account reflect the change in the stock, either in assets or the liability. The difference between the receipts and payment on the account of capital account, it refers to all financial transactions. Capital account balances, when we talk about the capital account balances, it can be surplus or deficit in the capital account, which include private foreign loan flow, movement in the capital flow, that is movement in the banking, official capital transaction, reserves, whole movement, etc. These are divided into, the capital account are basically divided into these two categories: direct foreign investment and portfolio investment. Then comes about the reserve account. Reserve account is the composite of three important accounts, that is IMF, STR, and reserve and monetary pool, which are collectively called as reserve account. IMF contain the purchases and the repurchase, that is both the credit and debits from the International Monetary Fund. Then comes about the errors and omissions. This is a specimen of balance of payment, which include both the receipt, that's the credit, and the debit side. The very important challenge, or one of the greatest concern that most of the developing and underdeveloped economy faces at present, are the disequilibrium in the balance of payment. So basically deficit BOP. When we talk about the disequilibrium, either demand exceeding the supply or supply exceeding the demand. So basically it is a surplus BOP or deficit BOP. So basically the surplus BOP occurs when the total receipts exceeds the total payment, and deficit BOP is when the total payment exceeds the total receipt. So both the surplus and the deficit BOP are considered as the disequilibrium in balance of payment situation. Few certain causes for the BOP situations are cyclical fluctuations, basically about the operation of business cycle. Second one, about the trade deficit, basically when an economy's imports exceeds than the exports of the economy. So basically it is the shortfall in the exports of an economy. Then the various phases of economic development. For example, these developing and underdeveloped economy give a lot of emphasis on development projects, which end up in lot of borrowing. So that also results in BOP disequilibrium. Rapid increase in the population, countries like India and other underdeveloped developing economies have this issue as well. This is one of the important reasons that we encounter BOP deficit every time. And structural changes, the changes in the various the structure of an economy. It can be age composition, it can be changes in demand, it can be changes in the total supply, demand, production, etc. Then comes about the natural calamities and international capital movement. So these are the few causes for the BOP disequilibrium. Then talking about measures to correct the BOP disequilibrium, we have monetary measures, we have non-monetary measures as well. Talking about the monetary measures, we have monetary, and in non-monetary measures, we have fiscal and other measures. Monetary measures, as the name itself indicates, it's basically with regard to, or which is in connection with the monetary policies of RBI, that's the central bank. Fiscal policy is something very concerned with the public authority. And certain important steps taken to remove or to correct the BOP disequilibrium are exchange rate depreciation, devaluation, deflation, exchange control, and few non-monetary measures like export promotion, import substitution, import control, like via imposing quotas or tariffs, etc. Thank you.